I think the residential sectors are, and that's probably my focus, so I'm slightly biased, but the fact is really across the developed world, we have a shortage of good quality housing. And I think, whether it's the US, whether it's the UK, and even across Europe, it is difficult for people to get onto the housing ladder, and the quality of housing is poor. So really there's a huge opportunity for institutions to come into, and private investors to come into the residential space. The income profile is very much what kind of investors are looking for. You can annually index rents. It's non-correlated to other markets as well. The fact is with the residential sectors, it's a utility. It's not discretionary. It doesn't matter what is going on in the wider world. You still need a bed in whatever form it's delivered at the end of every evening. So, it doesn't correlate itself to wider movements in the world. Whereas, offices, people can take less space, take more space as they feel more confident. Retail, we've seen that changing. And I think we're seeing certainly innovation within that space.
There's definitely been less capital chasing core plus because core plus has been a bit more expensive, right? So one of the reasons there's less is because there were a lot of people chasing core plus assets before the pandemic. We had low interest rate environment. It was easy to find some strong income producing asset and you can lever on it. You can get a better yield. It's positive carry. Now we're facing increasing interest rates. Yields are going lower, but at the same time, I kind of alluded to before, you don't really face a lot of that volatility. So pricing hasn't really particularly adjusted, right? So it still remains relatively expensive in core plus. So I think just generally, that's one of the reasons why there are just fewer capital chasing the core plus, but people still want returns. People still want yield. People still want exposure to real estate. So as such, I think there are basically more people looking at it in a different angle, say taking a little bit more risk. To Patty's point, there's things are getting more operational. So maybe taking operational risk, going up the risk curve, doing a little bit of value add work, right? And then maybe creating something that's more green. And so then you can extract more value from that. So just looking at different ways to chase yield, build to core, then your yield to cost is much lower than buying in, if you're developing as opposed to buying in at these higher prices that you're seeing today.
We have to find these mitigations to these conditions. And I think it starts with really understanding your product and getting closer to the process. And where the development management piece of our industry comes in is partnering very closely with that supply chain, starting with the main contractors, the general contractors, kind of injecting ourselves into that process and finding creative ways to buy, to build, to redesign. We've looked at, Nick and I have worked on a project together where we've pivoted the entire scheme away from steel and precast, where steel rates almost doubled, if not tripled, to poured in place concrete, where they're only experiencing 9-10% increases. So it takes a tremendous amount of brain damage to do these things, but the ultimate goal is to build better product more cost effectively within the schedule and within the business plan. And I think it's our job to tackle these things case by case, and ultimately at some point there will be cost compression, there will be interest rate compression. At that point, if we've done the things that we're supposed to do, that the projects, to Nick's point, are only going to be in a good place because we've underwritten a downside scenario, and hopefully we see some upside on the back end.
One is building as of right. So this is essentially building within the confines of the existing zoning. So you're not asking the municipality to build something that you're not currently allowed to build. And there's a couple advantages to this. One is it, circumvents all entitlement risk, right? You're designing what's currently allowed and the city can't say no. It also expedites the design timeline. So instead of having to go through a re-entitlement process, which can take 24 months, which was the case on one of my projects, you can cut that time in half, if not more. And then from a underwriting perspective, a lot of U.S. cities, if you do re-entitle a piece of dirt, you have to incorporate affordable housing. And that can be really difficult, especially in today's environment where every basis point matters.
Looking at partnerships that deliver all the way along the value chain, I think are really important. I think sometimes previous real estate joint ventures have probably not focused on a vertical kind of integration, more on a horizontal. So you might find two fund managers coming together, but that still doesn't solve the issue of who's actually going to operate the building. You need partnerships who are all the way along that kind of value chain from a more of a vertical position rather than a kind of horizontal. Yeah, and I think not being afraid of taking that operational risk, but doing it in a way that you're not hyper specialized as well. That's the big risk, is that you can really just specialize on one vertical, or one really thin market, and you put all of your eggs into that basket. You want the ability to be able to pivot or to broaden out. And actually that's where when we look at things like integrated living becomes really, really interesting. And we look at big developments around the world. They do it very well in the US. Where we have multifamily, senior housing, student housing, all on one plot or within one development. Where you're able to actually create those management efficiencies, but it's one manager or one JV partner, but they've got several different kind of hats and go-to-market strategies.
So I think that we've gone through a period of change in human behavior, how we live, how we spend our time, how we shop. And I think that's the world we live in now, is beds and sheds, right? We went through a period of 2 years where people didn't leave their homes. They didn't go to the supermarket. They didn't, go to a department store. We're heavily reliant now on shipping companies and, to the doorstep delivery. So I think as developers, and to pick up on the point of future-proofing assets, we need to anticipate these behaviors and understand what people need now, what people need tomorrow, what we think they're going to need the day after that, and staying relevant and versatile, right? We have to deal with the pricing issues, the interest rate issues, obviously representing our investors, but more importantly, the success of that investment really is dependent on our ability to lease. So I often joke with Peter that building is difficult, right? People are difficult, environment is difficult, politics are difficult, right? That's what we deal with every single day. So the actual building is pretty straightforward. So I think, those are the three challenges that I live with every single day. And that's why we do what we do.